Oh, for the love of insurance. On this episode of Through the Pines, we'll discuss the importance of insurance when it comes to your finances. Why do we have insurance? The invention of insurance. What is a loss ratio? The most important insurances like auto, health, life, disability, etc. And what are HSAs? And should you have one? Welcome to a financial planning podcast with a down-to-earth vibe. Sasquatch listens while sipping hot cocoa. This is Through the Pines. Our advisors for this episode, we welcome back Rex Baxter and Brandyn Smith from planwithbaxter.com. They are the 2023 and 2024 Forbes Best in State Wealth Management teams for Utah, as well as the Advisor Hub fastest growing advisors to watch under $1 billion, and the receivers of the Ameriprise Client Experience Award. Welcome to the show, to the program, Rex and Brandyn. Yay. I have applause for you. There we go.
Yay. Wow.
I know. We're stepping up the production just
That was
slightly.
applause, not fireworks, right?
That was applause. Yeah, not fireworks.
Okay. All right.
Those of you listening, if you would like to learn more about what Rex and Brandyn do, please visit planwithbaxter.com to learn all the things. On this particular episode, however, we'll be diving into insurance. Unfortunately, insurance has made the news because of some bad news recently, but we're not really diving into that side of things. This is planned weeks ago. We were looking more at, the invention of insurance, why we have it, and how it can help you financially so that you can structure your finances and not lose a bunch of money. And that's what insurance is supposed to help you do. So, Brandyn, I have you on here to kind of give us the idea of why we have insurance in the first place. Like, it was invented at some point in time.
Yeah. And when was it invented exactly? It's hard to say, but it's fun to look back through even ancient history and see when people have essentially used the fundamentals of insurance. And so one of those was Babylon, actually. And this is going back to 4,000, 3,000 BC. Babylon, merchants could actually go take out a loan to go buy goods overseas. And if those goods didn't make it to you, if they got lost in the ocean, pirates, stolen, you didn't have to pay the loan back. And so you might say, well, how do they do that? There's money to be made in lending money as well as bringing goods over to be sold. Yeah. And so they kind of price that into the contract. So the loans cost maybe a little bit more, but then you could have that assurance that if the goods didn't get to you, you weren't out of all of your wealth.
Right. And that's what we're trying to prevent, is losing all of our wealth.
Right. So you had that. Then you also, Romans had some systems in place that would protect against if someone were to pass away, that would take care of their family. Right. And so you can see, throughout time, people have there are things that you can do in life that are profitable, but just based on dumb luck, you might lose everything. Right. And that just doesn't sit well with humans usually, right? Because we're like, what? That's not fair. That doesn't make sense. And so that was kind of the advent of insurance. I remember one of my insurance professors from college was talking about that and talked about how one of the insurance companies that started was actually a group of guys, sailing merchants that were, going back and forth across the ocean and bring goods back and forth. But every once in a while, a ship would get lost at sea due to a storm or pirates or, all the different perils that there were. And, all of a sudden, your buddy that you were hanging out with the next week went from having a lot of money to not having any money. And they realized, hey, if we can band together, and just take, odds are we're going to be okay, right, overall. But one of us might suffer some real misfortune. And so if we can all just kind of take care of each other, that's the foundation of what insurance is.
Interesting. Now, okay, so I've got notes here that have been typed out that you kind of wanted to hit on, right? So, but I don't know if I heard you say the first word, which was the bottomry contracts.
Bottomry contracts.
Did I say that correctly?
Yeah, so those were the Babylonian ones that where merchants could borrow money and not have to pay it back if the goods weren't received. And so I think there's actually lots of different examples through history. as
Okay.
people have tried to figure out how to navigate risk, when sometimes you can do something that's profitable, but there's too much risk there that you might lose everything. And ultimately, that's the foundation of today, right? The insurances that we have today is to prevent that scenario when someone might do everything right, but then their house burns down, or they die prematurely, or they become disabled in an accident. It doesn't make sense that they have to live the rest of their life in financial ruin. And so we've developed insurances to protect against that. Now, that's not to say all insurance is good or all insurance is needed, but there are, and that's kind of today what we wanted to do is go through this and say, well, what are some of the more important insurances to make sure that you have in place? Because if something goes awry with one of these things, it could cause significant financial devastation.
Absolutely. Rex, on the importance of insurance and pooling your funds so you don't lose your bottomry. Do you want,
That's good.
you want to touch on that and how it's, it's used for good, I guess, or how we can use it to help us with our financial situation?
Yes, it's used for good.
Yeah. Okay, good.
No, I'm just kidding. So, um, yeah, I think insurance plays an important role in a lot of areas of our lives. And so when I think of insurance and I think of risk, there's essentially four different ways that I view that. You can either retain the risk and accept it, right? And so you're on the hook for it. You can remove the risk, and so I'll use auto for a second. We'll come back to auto later on. But if I want to retain the risk, then I just don't insure, and if I get in an accident, I've got to pay for it, and that's the way it goes. If I want to remove the risk, I don't drive, right? I just don't get in a car. I don't drive. I don't own any vehicles, that kind of thing. I can transfer the risk, which is where insurance comes into play. And so I can transfer that risk to an insurance company and have them take on the risk, and not with auto insurance, but more with investments and different kinds of things. You can diversify the risk. And so you can, like in stocks, instead of having everything in one stock, you can diversify across, 20 or 30 or 40. And so, but when you think about insurance, it's that third one. It's the transferring of risk from yourself to a third party. And that's what we're really talking about today. And I think that that's extremely important for people to understand what risks they're transferring, what risks they're retaining and accepting, and whether, which direction they want to go.
Okay. So should we change the name of insurance to like risk assessment or risk acceptance? Like how much
Risk
are you willing?
transfer.
Yeah, like how much are you willing to risk, and that's the money that goes to that, I guess.
But insurance just has a ring to it, right? I mean,
Uh,
might not be
it
a
also has
positive ring, but it has a ring.
a lot of other connotations. But Brandon, take us through some of the basics behind it, and starting with what a loss ratio is.
Yeah, so all insurance companies have what's called a loss ratio, which is a pre-calculated figure, basically, of all the premium dollars they receive, how much they're going to pay out, right? And it's interesting how similar there are variations to it, but when you look in general, loss ratios usually sit around 60%. And so what that means is for every dollar in premium that you pay an insurance company, they anticipate paying out about 60% of what you've paid them. And sometimes that catches people off guard. It makes sense though, right? I mean, insurance company, they have to pay for their building, they have to pay for their underwriters, their team of call centers, right? So when you call in, right, they have to pay usually commissions to people selling the insurance. And so there are a lot of different costs that go into place in putting into effect any insurance company or any insurance policy. And so you need to realize that insurance usually isn't a good investment, right? If we're paying $1 and we get 60 cents back, that's not financially, doesn't usually, we don't want to engage in more of that than we need to. The reality of all of us, right, is as we all have insurances and we're paying into these insurance policies. If you look at how much you pay in premiums versus how much you actually collect out of those, we're all pretty well losing, right, with an occasional winner here and there. And so I think going into this, it's important to realize insurance is good and it covers us in a time of need, but we also don't want to be overinsured. we don't want to buy too much insurance just because it's usually not a winning game. I will say though, sometimes what I do, because I need insurance to cover myself. If I were to pass away, I want to make sure my wife and my kids are taken care of. If I'm unable to work, I want to make sure that I don't lose my house, right? And so I have disability insurance and life insurance. And sometimes that's annoying to pay for, but it is fun sometimes to calculate the full amount, right? How much am I paying in life insurance and disability insurance premiums? And realize that actually 60% of that is actually going to people in need, right? I'm paying every month, and that 60% of everything I'm paying is going to someone who's lost a loved one, lost the ability to work, would be financially destitute without it, but they're actually being taken care of. And in return, if something ever happened to me, that I have a whole group of people who would then take care of me and my family if we needed it. And it's by contract, right? It's not just goodwill. And so maybe that's the warm fuzzies. I can almost see Rex smiling at me in the background here.
Rex is smiling, yeah.
I'm just wondering if that's a charitable gift. Do you get to write that off? Is that what you're saying that 60%?
No, that's paid for there.
Yeah.
Just trying to make you feel good.
Yeah. Rex, what are your thoughts on that optimistic take there from Brandyn? Which I like, by the way.
I think it's a great optimist, and that's what we love about Brandyn. Is he's the ever optimist, and so yeah, I pay the premiums. I certainly don't enjoy paying the premiums, and I don't quite get the same joy out of that as what I think Brandyn might get. And so I guess it should make me feel good that nobody wins with insurance in my mind, right? If you're having to make a claim on insurance, it means that if it's auto insurance, it means that you wrecked your car, or somebody hit you and you lost your car. If it's home insurance, it means maybe your house burned down and you've got to start from scratch. If it's life insurance, it means that you're gone and you're not here. And I don't think that means that you won necessarily. And so I have a hard time viewing it from that light. I think it is a necessary part of being responsible and a necessary part of protecting your net worth and protecting the things that you can't self-insure for. And so I think it's very needed and very important, which is why we wanted to spend some time today going through it.
Okay, excellent. Well, let's dive into some of the different types of insurance, why they are important, beginning with homeowners insurance, Brandyn.
Yeah, so homeowners insurance is extremely important if you own a home. If you're renting, you can do renter's insurance. But essentially what that covers is it covers your home, covers belongings in it, and some lawsuits. And it's important to know that not all homeowners insurance policies are created equal. There's actually quite a range in what is being covered under a homeowner's policy. It's really interesting to actually read through what is included and what is excluded, right? Oftentimes acts of war, right, are excluded. Missiles, are excluded, not as an act of war, but they something falling from the sky, off an airplane or something, right? There's a lot of funny things in there that why did they do that?
I did not know that.
Oh yeah, there's all sorts of stuff that's not covered on homeowners insurance policies. And so, like I said, you can really get into the weeds, and that's where we advise you to go to a qualified, homeowners insurance, someone that just does home and auto, right? That can really help you kind of dissect your policy. One that's a lot of people may or may not realize is earthquake insurance. Earthquakes are not covered under a homeowner's policy generally, and so you need to go and get those separately. And it's always interesting to talk to people about those, right? Because there's so many different beliefs. Earthquake insurance is not cheap, especially here in Utah, right? Where we know we're on a fault line, but it almost doubles your insurance policy. But do you get earthquake or do you risk it, right? And I think it ultimately comes down to, well, what happens, right? If there was an earthquake and your home was damaged to the point you couldn't live in it, how does that impact your financial plan? And for some people, they'd be fine, right? We'd be able to pay for it. We make the repairs. Chances are the repairs are not the full replacement value of the house. But then for other people, that wouldn't be the case, right? And so having those discussions, it's good to be conscious about those things.
Interesting. Rex?
It's interesting after, 25, almost 30 years in the industry, how many different situations, as I think back, that we've come across. Because homeowners insurance is always it's interesting to me because there's so many exclusions, but then on top of that, there's a lot of riders that you can add. And so a lot of our clients sometimes will add riders for jewelry. If they have, your normal homeowners insurance will cover up to a certain dollar amount of different kinds of assets. It'll cover up to a certain dollar amount of your personal property. It'll cover a certain dollar amount of jewelry. It'll cover a certain dollar amount of just things that you have. And so it's, a case in point is a lot of times we'll have clients that, whether it's jewelry or not, but sometimes they'll keep cash in the house. Sometimes they'll keep gold bars or silver bars. And so there was a situation, this is going back a long time now, but to where a client had kept some physical bars, gold and silver bars in their garage, and the garage had burned down, but it had accelerants in there to where it burned at a really, really hot temperature. It melted the bars that were in the garage, and they were only able to recover a certain amount of that gold and silver.
Wow. Yeah.
And they hadn't added that as an additional rider. And so, had they had they had serial numbers, had they added it as a rider, then they could have recovered, the portion that wasn't able to be recovered through as it melted down and kind of sifted into other things. They weren't able to recover all of that. And so it's just interesting to read through your policies, understand what you have. If you have a lot of Halloween decorations, for instance,
yeah.
just as an example, as a random example, you might want to have a rider for some of those additional animatronics that you have stored somewhere.
Rex, what is the, off the top of your head, the value of your Halloween animatronics? I can't even say the word that you may have in storage.
I don't know. I honestly tried to count how many animatronics we have for the house last year, this past October, 2 months ago, and I lost count. It was a large number. I ran out of fingers. I ran out of toes. And so, yeah, it was a lot.
Does that passion, roll over into the Christmas animatronics as well, or no?
No, I think I've mentioned before that when I was married, we had talked and she really liked different holidays. And I said, I will get behind you 100% on one holiday. And when she picked Halloween, I was like, oh, this will be great. This will be easy. There can't be that many Halloween decorations. We'll buy a couple of witches, whatever. And lo and behold, wow, she picked the one with the most animatronics of all of them, I think. So
should have gone with Valentine's or something.
Right? Or St. Patrick's Day or 4th of July. Day. I don't know, something. But
Brandyn, when you're reviewing your insurance policies, I don't know, how often should you do that? And also talk to me about the importance of making sure the coverage mounts are up to date.
Yeah, really important, especially recently while properties have appreciated so strongly. You might take out a policy on your house, and your house was comfortably worth $400,000, but now it's worth $600,000. A few years later, and the insurance company, if the insurance policy hasn't been brought up to date, then you could be underinsured. And a lot of times people think, well, that's bad. If my whole house burns to the ground, then I only get $400,000. And while that is an issue, the bigger issue is even partial claims, right? So if you have something happen, they're going to look at it and say, whoa, you didn't have the proper coverage, and they'll actually bring down how much they will cover. And so, again, I think just reiterating, we're not saying make sure you have the biggest, most comprehensive insurance policy that is ever sold. But what we are saying is make sure you're working with a professional, not us, but a professional who specializes in home and auto insurance, and get to the bottom of what am I covered for? What happens if, just make sure everything is in line, that you're getting a good price for what you're paying for in the contract. And that's probably the best advice I have for homeowners insurance.
Okay. And then Rex, do you want to start us off with auto insurance?
I do. I really have been
I really do.
Starting us off with auto insurance.
Wait a minute, Rex. Are you saying insurance isn't your favorite? Come on now.
Yeah, insurance it's a necessary thing. So,
Well, what about auto insurance? So I remember when I got my first car, and I didn't have a loan on it. I think I paid $300. I mean, it was a beater. And, I remember I had to have insurance. I'm like, why? Like, what? I'm not even going to need this car. Like, if somebody hits it, it's done. It's $300. Like, why do I need insurance? And they're like, well, what if you hit somebody else and you destroy their car? I thought, oh, well, yeah, I don't want to have to pay for their car, so I guess I need insurance. But I didn't really understand with the $300 car why I needed insurance on my vehicle,
well, and that's why we're talking about it, because a lot of people
Yeah.
don't understand, all the ramifications of insurance and what it can cover. And so if you're in a $300 vehicle and you hit a, $90,000 or $120,000 Tesla, and you're at fault, right? And not only can they come after the insurance, but depending upon your policy limits, they may be able to come after you personally in addition. And so again, you're transferring the risk to protect your own assets. And so you need to take a step back. And insurance is one of these items, one of these tools where lots of times you don't want to go with the cheapest provider, right? There's certain things in life that you don't always necessarily want to go with the cheapest provider. And one of those might be somebody that makes airplanes. One of those might be, insurance.
Yeah.
And so, lots of times you get what you pay for. And that's why it's important that you understand the policy and what's included in it. One of the things on auto insurance that I get asked a lot is, my son or daughter just turned 16 and they have their learner's permit. When do I add them to my auto policy? And the answer is, it depends. It depends on your auto policy. Some auto policies require you to add, your child as soon as they get their learner's permit. Other policies require, you to not add them until they have their license and they're going to be driving your car on a regular basis. And so it really is important that you understand your individual policy and that it's going to cover you for what you're wanting it to cover you for.
Okay, Brandon, what about amounts, basic coverage amounts?
Yeah, so a lot of times you hear numbers like 25, 65, 15, or 100, 300, 100, right? And what there's three numbers, and they stand for three coverage amounts. So the first number is per person. So let's just say you have coverage of 100, 300, 100. The first number, 100, stands for 100,000, and that's per person. So each individual is covered up to $100,000. The second number is per accident. So that 300 would be 300,000 per accident. So let's say, for example, you get in an accident with four people in a car, everyone goes to the hospital and runs up a $100,000 hospital bill. Well, you've got your $100,000 per person, but then that's capped at your per accident, the 300,000, right? So insurance will stop paying money out at $300,000. And then, or 100,000, whichever comes first. And then finally, the last number, it stands for 100,000 of property damage per accident. So crashing into another vehicle. But a lot of times people see those numbers and they're like, wow, that's a ton, until you realize medical bills get so expensive, right? I mean, you can run up $100,000 medical bill pretty quick. And so it comes back to what Rex said, right? What happens if you have the state minimums, which in Utah was crazy low? They just increased it, but it's still pretty low, right? The minimum is 25,000, 65,000, 15,000.
Oh, wow.
Right. So 25,000 per person, 65,000 total per accident. There's a lot of cars on the road that the car alone is worth more than 65,000, and $15,000 of property damage. Right. So the 15,000 would be the vehicle. And so the question that everybody should be asking is, well, what happens if someone hits me and they've got 15,000? Their insurance company says, yeah, we'll write a check for the full amount. Here's 15 grand. Right, but your car's worth 40. What do you do?
Wait, and that's legal in Utah right now?
Yeah. Oh yeah. And so what happens? Well, if you're the person with the car that got damaged, the insurance company for the other person that hit you writes you a check. Here's your $15,000. Now what? Well, you can go to an attorney and you can sue them. You can sue the person who hit you, who didn't have appropriate coverage limits. And that's something, to be aware of, right? Especially if you've built a net worth, you don't want to have low coverage limits, because the last thing we want is one accident to come and all of a sudden we've got an attorney suing us for $250,000, right?
Hmm.
And on top of that, sorry, getting back to like the more emotional side of it, I also want to make sure I've got enough coverage so that if I hurt somebody, I don't have to say sorry. Like, sorry, I'll take care of half of your car or half of your hospital bill, right? Like emotionally, morally, it feels good to have insurance limits such that if I hurt somebody, then I'm confident that I can make it right, the insurance. But anyway, getting back from that, how do you protect yourself? Well, you can get underinsured or uninsured motorists. And that's something that's really important, especially when you look at the stats of how many people are driving, just straight driving without insurance, or that are driving with these state minimums. Well, what happens? Well, you can sue them, but a lot of times people who are running with state minimums don't have any assets to sue, right? Like
How does it work, Brandon, if someone steals your car and then hits somebody else with your car?
I don't know how that, if someone steals your car and then hits someone with your car. Yeah, I don't think you're going to be, I don't know, but I wouldn't think you'd be liable for that.
Yeah, I would hope not. Yeah. Because it's, I mean, a friend of mine's son had their car stolen the other day, and I'm just thinking about that. Well, what happens if they cause damage, like whose insurance does that come out of?
So typically the insurance companies will argue that out to see if there's some sort of shared liability, right? If you left your keys in your car and somebody got in and started it up, and let's say the person was 10, right? 10-year-old starts up your car because they were able to get in it, the keys were in it, they hit the gas, they pull forward, 50 feet and hit your neighbor's truck, you're going to have some shared responsibility. Even though technically that 10-year-old stole your car, you're going to have some, because you made it easy for him and you didn't protect your car, you're going to have a shared liability. And so that's what the insurance companies are going to argue out. And your insurance company is there to protect you and to protect themselves from those claims. So they're going to fight that fairly rigorously, but they're also going to try and settle out as they weigh the issues of how much does it cost to argue this versus and pay the attorneys and to wait out the time versus just settling for some amount, removing their risk and their, washing their hands of it. And then that damaged party may come after you personally at some point. So it gets very complex, which again comes back to working with a professional that can help walk you through what coverages you have, how that works, and help you understand your policy specifically, because they are all so unique.
Yeah, for sure. And oh, by the way, in northern Utah, it rained last night. You know where I'm going with this, Rex?
Flood?
Umbrella insurance.
Umbrella insurance. How did I not pick up on that?
Come on now.
Yeah, I should have.
It's the Mary Poppins of all insurance.
It is the Mary Poppins. Yeah.
What the hell is it? I mean, we're not insuring umbrellas. Like what are we talking about here?
Well, an umbrella protects a wide area, right? And so that's what an umbrella insurance policy does is you have your auto insurance, and let's say you've got your 100, 300, 100 coverage, and you're in a horrific accident where somebody loses their life, right? Or they're permanently disabled, and you've got maybe up to a lifetime, risk assessment, damage assessment of maybe $1 million, $1.5 million, $2 million. Well, that umbrella insurance covers up to the umbrella insurance amount, which frequently people look at $1 million or $2 million policies on the umbrella insurance. And so it covers from that $300,000 per accident or the $100,000 per property damage up to, for the next $1 million of coverage for the umbrella. And so that umbrella is an add-on insurance. Typically, they're not overly expensive. I'm not sure where rates are at, but back when I started in the business, you might pay $300 a year for $1 million policy.
Is that just because they're not used a lot?
Right, because most accidents fall underneath those other coverage amounts.
Okay.
Or your homeowner's coverage. And so they're not used, they don't get tapped into all that often, but they are there just in case.
Okay, Brandon?
just more of a catastrophic. And so they usually will make you increase like your auto insurance, your home insurance. So you've got really nice policies there. And then the umbrella is just on top to kind of catch everything else, that like lawsuits that might not be covered, injuries, rental liabilities. I mean, there's a lot of different little one-off things that umbrella insurance can cover.
Well, then let's talk health insurance. That is probably one of the more debated insurances out there right now, especially. And, I mean, I just had to put a chunk of change down on some of my own kids yesterday morning and I'm like, man, I pay insurance. Why am I forking out thousands of dollars also? And so let's chat about the health insurance and why we need it and how much do we need of it and what changes need to be made in that industry, Brandon.
I would love to do a podcast on how we can fix it.
Yeah, wrap that all up in a nice little 3-minute bow for us.
Probably not doing that today. I have some ideas, but not today. But as far as like our topic of important insurances to have, health insurance is one of those. Health insurance, medical debt is one of the leading causes of bankruptcy. And it's easy to see why, right? I mean, you look at these hospital bills. I remember with one of our kids, we went to the hospital and said, hey, if we had insurance, but it was high deductible. I went and I was like, hey, can we just pay cash? Like, we'll just pay you. And then that way, maybe we get a discount or something. She's like, no, you don't want to do that. I was like, no, really, what is it? But she's like, oh, and $40,000 for a healthy kid, just the hospital bill. I mean, it was insane. And so, I mean, the costs have gone up so much. And so, I mean, having health insurance, you just never know, right? And the main concerns are, what if you have like an accident where all of a sudden overnight you're running up hundreds of thousands of dollars of medical bills? How does that work? Potentially even scarier is if you get like cancer and the doctor, you meet with the doctor and he says, hey, we can fix this, but we need to get started right now. If you don't have insurance, there's a lot. In fact, I've been told most places won't even start the coverage, right? Because it's so expensive and they know you can't pay for it. And so now you're sitting here and unable to fight a curable disease because we didn't have insurance. And so it's just with insurance, it's about avoiding those rare but really big deals, right? So something that probably won't happen, but if it did, it would be very devastating. That's where insurance plays best, and health insurance is one of those arenas for sure.
Yeah, Rex, how do you approach health insurance when it comes to your financials and also your family, most importantly, because you have one of those families where if you're paying cash for every kid, that's a lot of cash.
That is a lot of cash. You're saying I have a lot of kids?
Big family, big kids. Yeah, which is important this day and age to have. And so, you would think like, oh my gosh, the amount of insurance that guy pays for health insurance must be unreal.
Yeah, it is unreal. But health insurance typically on like group policies and through your company, typically the premiums cap out, which actually works out fairly well for bigger families. It is interesting. I was working with one of my adult children here this last week on their health insurance, and so they're self-employed, and so they're using the Utah marketplace for insurance.
Are they over 26?
They are. Yep.
Okay.
They are. So they're on their own policy on their own. And so we were just running through different policies, and last year this child had gone with the cheapest option, which, because being self-employed and lower income with government offsets, it's a high deductible plan, but it ran like $2 a month, right? $3 a month for their health insurance. Now, the first 10 grand is out of pocket,
sure,
right? And so you've got a lot of out of pocket coverage, but it covers kind of, emergencies and major big issues. But as we were going through the policy that they had, they wouldn't cover anything that happened outside of the state of Utah. And so if this child was in Colorado and doing something and going to a Denver Broncos game or something and had a health issue and had to go to the ER or anything like that, the health insurance wouldn't cover anything. They just claimed all coverage from out of state. And so as we were reviewing different policies, in this case, we end up going with a $22, $25 policy that would end up covering, the child anywhere that they travel, as far as up to those limits and, with the deductibles and things like that. And so I think it's really important that you do actually read the policies and that you understand it. And if you don't understand it, or it's using language that you're not familiar with and uncomfortable with, that you're working with a professional to help walk you through what is covered and what isn't covered.
Yeah. Brandon?
Yeah, I think the one last part on health insurance is a lot of times people, I can't tell you how many times I've heard someone say that they're not going to retire until age 65 because that's when they can get on Medicare. And that's true. That's when Medicare kicks in. But it's actually a lot easier than people think to get coverage in place. Even if you don't have an employer offering it, you can go out and go on get an ACA plan, Affordable Care Act plan. Those premiums are based on your income. So if you're retired, sometimes they're not too bad. But I guess I'd just say if that's something you're worried about, you're like, hey, I'm ready to retire. I just need health insurance. That's usually we can find a way around that. Even if we have to pay some premiums, dollar amounts relatively small relative to an extra year or two of retirement life that you get. And so anyway, it is important that you don't just quit and go without insurance. And if you lose a job, right, you can jump on a new insurance. That's a qualifying event usually. And so anyway, just I would say make sure you always have something in place, and it's good to review the policy and know exactly what those coverage amounts are.
I will say, back in the day, I went through, we'll call it a life event, and I was self-employed and I had to go, I'm like, oh, well, I need insurance. And so I went and I got a job, and at that job, I met my current wife. I hired her. Not on purpose. I was still like,
insurance leads to love.
Insurance leads to love. On the next episode of Through the Pines, insurance leads to love. Yeah, I really I needed a job, and I took a job with a retailer that had a good insurance. I didn't love the job, but I met my future wife there, which was pretty awesome. Brandon, do you have some more numbers?
I do. Yeah.
So insurance can be good. See, Rex, come on.
Insurance can be good.
Or the need of it.
For the love of it.
For the love of it.
Sure. This one's kind of fun. This is JP Morgan did this, and there's plenty of them out there, but they went back over the past about 40, 50 years, 42 years, and they looked at the average rate of return of the stock market. And they looked at how many times it was up and how many times it was down. Any guesses on up 42 years, how many times the stock market was positive at the end of the year? These are calendar years.
Oh, calendar years. After 42 years?
Yeah, of 42 years, how many do you think ended up positive?
Oh, okay. I pick a number without going over. 26.
Yeah, don't go over because there's only 42 years. So
no,
26, not bad. 32.
30. Oh, okay.
30. Oh, Rex was just about to guess 32, and I interrupt. Sorry.
So
he's in the business.
But yeah, 32 of the 42 years. And so it's kind of funny talking about insurance, right? Insurance is kind of a losing bet, but the market in a lot of, in a lot of ways is a winning bet, right? It's not always up. Sometimes it's down. But 32 of the 42 years, it's positive. It's interesting, of all of the 42 years, guess what the average intra-year drop was? Meaning, on average, how far down did the market go at any point in time? How far negative did it go?
As a percentage?
Uh-huh.
All right, 3. We're going to do who's closer, Brandon, you or I, okay. Right?
I just went 3.
I'm going 17.
Oh, man. I thought 10 at first, and I thought, oh, that sounds high. But you're
14% on average every year.
10. Shoot.
Yeah, I mean, just crazy. And so I think the takeaway is that, markets generally are up. And you look at average rates of return over the last 50 years, and it's just incredible, right? And it depends on which segment of time you use, but they're high, right? Most of them are kind of 10% average rates of return over 50 years, with 32 of the 42 years being positive. And yet, even with that, each year on average, we dropped 14%. But you think about when the market's down 10, I mean, everyone's losing their minds, right? Here comes the next 2008, it's all over. And so keeping things in perspective is really important.
And if it went down 17, like Rex predicted, that would be mass panic.
It is though. I mean, when you get down 17, 20%, people think that something's broken.
Yeah.
It's not.
It's not. And speaking of broken, Brandon, let's go into our life insurance here. You got to have it. You got to have it until you don't need it, or should you always have it?
Yeah, so that was one of my first question, right? When do I need life insurance? Yeah. I've sat through presentations from other people where they're like, you always need life insurance. Why? Because you're going to die and there will be a funeral expense. It's like, well, do you really need it if you've got a net worth of $10 million? Like, do I really need to be going to an insurance company saying, hey, where's my $15,000 of insurance? No, like, of course you do. And so the question becomes, and it's a good question to ask, if I were to pass away today, how much money would be needed to take care of those who are financially dependent on me? And that's truly, if you can come to the bottom of that answer, and Rex and I can help people come to the bottom of that answer. But that's the answer to your insurance question, is if I were to die today, how much insurance or how much money is going to be needed to take care of those who are financially dependent on me? And you might argue, and those that might be dependent on me in the future, right? Sometimes people do that, but really it's, in my opinion, it's what is the need today? If you were to pass away today, how much coverage do you need? And that kind of provides the amount. Once you have the amount, then you ask the question of how long, right? Like, how long is this always going to be that high? Right now, I've got a young family, right? 3 kids, 12, 9, and 6. And if I were to pass away today, I mean, I'd want my wife to still be able to take care of it. I don't want her like working 3 jobs, right? And so I want to take care of that. Yeah. And I'd say there's a minimum, right? You want to make sure that your families at least have their needs taken care of so they don't have to move and that they can get by. But then a lot of times you get to the next level of, hey, do I want them to change their lifestyle? Like, do I want them to say, sorry, dad died, no more vacations, right? Or no. And a lot of times the answer is no. And especially where life insurance is so inexpensive, a lot of times it makes sense to hold on to some amount of coverage.
Yeah. Rex, as a financial planner, variable universal life is the only way to go, right?
That's what I hear frequently, although the answer would be no, or it depends. Universal life is one of those products that every product has a place, and universal life is that it has a place. Unfortunately, a lot of times it gets sold as a cure-all. It gets sold as a retirement plan. It gets sold as a life insurance policy. It gets sold as a line of credit. It gets sold as all these different kinds of things. And it's when you start using it for tool or for reasons other than what it was created for, it can get a little bit expensive. And so you want to look at that, not in a vacuum, but you want to look at that within why was it created? What am I trying to insure? What am I going to use it for?
On life insurance, Brandon, what did we miss? Anything?
A couple of quick things. Group insurance versus individual insurance. Most times, if you're healthy, we can get an individual policy a lot less expensive than a group policy. It makes sense as you think about it. Group policies, if they're not asking you a lot of insurance questions, they're anticipating that people who are unhealthy are likely going to apply for more. And so they have to base that into the underwriting. And so if you're willing to go to an insurance company and prove, hey, I'm healthy, I don't have any, issues that would likely cause my premature death, we can usually get a less expensive policy. Not only that, it's portable. If you're on a group life insurance policy and you have to change jobs, you can't take that group life insurance policy with you most times. And so an individual policy can make more sense that way.
Okay. Rex, talk to me about disability insurance. Why do we need it?
Because sometimes we're unable to work because we got disabled. And so we need disability insurance for that reason. Yeah. So I can't remember what the statistic is, but it's significantly more people tap into disability insurance than ever use life insurance and experience some sort of disability, whether it be short term or long term,
Mm.
during their working life, as opposed to life insurance. I find it interesting. Most companies provide a level of disability insurance that covers, the most common we see is 60% of your pay or 66% of your pay up to some sort of cap. What we find with a lot of our clients is that they make more than the cap. And so a lot of times the cap may be at $15,000 a month that will cover 60% of your pay up to $15,000 a month. But a lot of times we have clients that may be making $30,000 a month or $50,000 a month. And so they need an additional private disability policy to cover that additional 60% of their income in order to protect themselves and and their family if something were to happen. Now, some smaller companies don't carry or provide for disability insurance at all. And sometimes when you're younger, you just don't think about that. You don't think about when you have, you're starting out your family, you might be 30 and have two kids, and you're working for a small startup company or something along those lines. They may not have a disability policy included in their company. And so, I think it's important for you to recognize that more people will experience disability during their lifetime than the need for a life insurance. And so it's probably in my ranking order, right? You have your home and your auto, which are critical. Disability would be next. Life insurance would be next. And then eventually we would get down to long-term care insurance. Health insurance is probably very first between all those things, because
Yeah.
I feel like that's the first thing that's going to derail your finances.
Brandyn, before we dive into the last insurance type here, the long-term care insurance, we skipped over having an HSA on the health insurance. You want to just describe what that is real quick?
Yeah. So love HSA accounts, health savings accounts. What they allow you to do is put money in pre-tax, and so you get a tax deduction on it. It grows. Once you get a certain amount, usually you can start investing that, and you can grows tax free, and you can pull it out completely tax free for any qualifying medical expense, and it's quite a wide list, right? Supplemental vitamins can be on that list, chiropractic, doctors, dental, vision, and as well as long-term care expenses in retirement. And so the odds of a retiree being able to get HSA money out tax-free are usually pretty good, which there's no other account in the tax code that gives you a tax deduction for contribution, tax-free growth, and then tax-free on the distribution. And so HSA accounts are a really beneficial thing. If you want to contribute to an HSA account, you have to be enrolled in an HSA eligible health insurance plan, which are usually they're higher deductible plans. And so you have to make sure you look at that and say, hey, does this health insurance fit within my needs for insurance? But if it does, those HSA accounts can be really, really helpful.
So my wife and I use an HSA. So her policy where she works allows her to have an HSA, and they actually will her work will contribute to it as well, which is nice. And so see if your work will contribute to your HSA, and then we'll set up like payment plans. So like when on dental work, and it'll just come out of our HSA monthly, and then we don't have to kick them a big old chunk of change. Which is nice. Right. So that's one way to use it. Yeah.
The other thing on HSA plans is it's better if you can to fund those through payroll. So you just have a certain amount pulled out of your paycheck. That can knock off that FICA tax as well. Mm-hmm. So you're getting extra tax savings in addition to the federal and state. You can also lump sum, like drop a chunk in, right? If you have that eligible health insurance plan, you're below the limit, which I think for 2025 is $8,550 or so. We'll have to check that, but I'm pretty sure that's exactly it. But you need they limit how much you can put into an HSA account. So you can lump sum it in, but you miss the FICA deduction. So if you can do that through payroll, that really helps.
Yeah. Rex, on this last subject, we have a full podcast on this, so people can, and a lot of our podcasts are evergreen. You can go back and listen to We have insurance and we have one on long-term care insurance, but you want to talk about the basics of it and why we need long-term care
Yeah, I
insurance?
think I think long-term care insurance essentially insures us for when we're, typically older and needing assistance with what the insurance industry calls as the six activities of daily living. And those six activities of daily living are if you're struggling with bathing, eating, dressing, toileting, transferring, or continence, then long-term care insurance that's when that would kick in. And most insurance companies require you to have issues with four of the six. Some policies will be three of the six, some policies are five of the six. And so you want to pay attention to what your policy needs in order for it to kick in the benefits. But most people will experience some sort of long-term care need in the later stages of their life, and normally that lasts for about, on average, I think last report that I saw was about 18 months
Mm.
was the average need for long-term care insurance. That once you start having problems with about four of those six activities of daily living, and you go into a care center and you're needing help, that the average stay is about 18 months.
Mm.
And that can get really expensive in those care centers. I've seen everything from about 4,000 on the lower end for a care center, all the way up to sometimes with in-home care, I've seen it range up to 16 to 18,000 a month
Wow.
for in-home care. And so that's a lot that can, bring down your estate, bring down your net worth. And so again, it comes down to, is this something that I want to self-insure for and I want to retain the risk, or is this something that I want to transfer to an insurance company and have them insure? Now, the downside is that typically you need to pick these insurance policies up. The sweet spot is normally in your 50s and 60s, that you're having to pick these up. And so you may be paying premiums on these policies for 20 or 30 years before you actually see the benefit. And so that's a lot of money that you're putting into a policy over a long period of time. And those premiums are rarely locked, meaning that the premiums typically will increase as the risk of the long-term care increases within society, to where the medical expenses get more expensive, and because of modern medicine extending life periods and life expectancies, you may, that 18-month stay may go to 20 months or 24 months. And so they continue to increase the cost of a lot of these different kinds of long-term care insurance
Mm.
policies. But I think it depends on what somebody wants to do. I think there's a lot of different ways. There are actually life insurance policies that have what's called long-term care riders, to where you can access part of your life insurance policy, death benefit to cover some of your long-term care insurances. But boy, they're complex. I always talk to clients about some of the most complex instruments we deal with, and we deal with a lot of complex instruments, not just stocks and bonds, but we'll deal with alternative investments or hedge funds or different, private equity, different kinds of complex instruments. But I'm not sure that there's anything more complex than insurance. I
Mm.
think insurance is about as complex as the financial industry gets, in my mind.
If you want to be self-insured, that's one thing. But if you want to insure yourself that you've done it correctly, talk to a professional, but Brandon, talk to us about self-insurance, because it is an option. You can self-insure in some of these cases.
Yeah, and as you, like Rex was saying, you look at these policies and they're expensive. They put, a lot of them will put caps on the benefit amount for how much they're going to pay out. And then you look into some of the fine print and they start saying things like they can increase premiums by up to 25% per year. And a lot of these policies are increasing the premiums quite dramatically. And a lot of people say, hey, you know what? Kind of going back to that first, right? So that loss ratio of 60%. Man, if we're gonna have to pay in all this money, and the insurance company's kind of running the numbers so that they're making money on this. A lot of people say, hey, if we've got enough foresight and we've got enough wherewithal to plan for this, let's just save extra. Let's save extra into our 401ks. Let's save extra into our HSAs. Let's save extra into these other monies that if something were to happen, we'd be able to cover that. In addition to that, right, you don't need to, like, the in-home care is nice, but there's cheaper ways to do it, right? Sometimes spouses will kind of help out, and then when they do need it, they'll go find a good care facility that's a little bit more reasonable. So I mean, there's ways to get around it. There's no easy answer on long-term care. The main concern is that one spouse goes in to a care facility while the other spouse lives at home with all the same expenses. It's not like they turn the thermostat in half because there's only one person there, right? The expenses at home stay pretty well fixed. Then you have the extra monthly bills of long-term care insurance on top of it, and that can drain down plans' assets. And so that's what we're worried about. That's what we're preparing for. But just as a side note, if for a lot of times for single individuals, long-term care, the risk of that cost is a lot less. If you're not married or your spouse has passed, then a lot of times we've got a monthly income that could be reapplied to a care facility, or we can sell a house and move. I mean, there's a lot more options that way. And so really what I've found to work the best is if we can save extra, have a little bit extra in the retirement fund, so that we could cover that if that were to be the case.
Rex, I saw a post on X by some health guru that said, if you're under the age of 50, prepare to live till 150.
Oh my gosh.
Okay, we'll see.
Wow, 150.
See about that. Yeah.
Yeah. Well, AI and who knows, right? Robotic arms and who knows?
Prepare to live forever. Might as well have said that.
Yeah, I'm going to live forever.
Well, thank you, Rex and Brandon, for being on the show today to cover insurance or the basics. It's you just got a free Insurance 101 class from these two. But you're going to have questions. And so go to planwithbaxter.com and chat with them yourselves. Also, you can follow Plan with Baxter, or Through the Pines, I should say, on all the things like Facebook, Instagram, YouTube, where we put out our wonderful, beautiful faces to the world. If you're only listening to this as a podcast audio only, you can find us on YouTube. So this podcast was produced by the Banyan Collective, recorded in our camp trailer studio right here inside Banyan One. If you found value in this podcast, consider supporting us at buymeacoffee.com, where you can just give us all your money. Watch and subscribe to us on YouTube at Through the Pines, like our Facebook page at pines.com/Pines Podcast, and our Instagram as well at Pines_podcast. This has been Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.